Hello everyone, my name is Azara Vania Pradiva from Indonesian Technocrat University. Today, I will discuss the material from tax law entitled The Tax Collection System, Types of Taxes, Tax Rates, Tax Functions. Without further ado, let's move on to the discussion. 1. The Tax Collection System. The tax collection system refers to the mechanisms by which governments collect taxes from individuals, corporations, and other entities. This collection is crucial for generating revenue that supports various public services. The primary tax collection systems employed globally include a self-assessment system. In this system, taxpayers are responsible for calculating, reporting, and paying their own tax liabilities based on their income or other taxable factors. After taxpayers submit their calculations, tax authorities later audit or verify the information to ensure accuracy and compliance. This system fosters responsibility among taxpayers and reduces administrative burdens on tax authorities. B. Official assessment system. The tax authorities assess and determine the amount of tax that an individual or corporation owes, which they are then required to pay. This approach provides less flexibility for taxpayers but ensures direct oversight by tax authorities, often leading to higher accuracy in tax collection. C. Withholding system. In this system, taxes are directly withheld from an individual's income by a third party, typically an employer or financial institution, before the taxpayer receives their earnings. Commonly applied to wages, dividends, and investment income, this system ensures immediate collection and reduces the risk of non-compliance by taxpayers. These systems are tailored to each country's regulatory framework and taxpayer demographics. They aim to balance compliance, efficiency, and fairness in tax collection. 2. Types of taxes. Taxes are classified based on who bears the tax burden, how the taxes are applied, and the specific taxable activity. Major tax categories include 1. Direct taxes, paid directly by individuals or businesses to the government, typically based on income, profit, or property ownership. Examples of direct taxes include a. Income tax, levied on personal or corporate earnings. This is a primary revenue source for governments and is often calculated progressively based on income levels. B. Wealth tax, a tax on the value of assets owned by an individual or business, including cash, real estate, and investments.
C. Property tax, charged on real estate or property ownership, often at a local government level, to fund services like schools, road maintenance, and public safety. 2. Indirect taxes. These are taxes on goods and services rather than on income or profits. Indirect taxes are typically included in the price of goods and services, making them less visible to consumers. Examples include a. Value-added tax, VAT applied to each stage of production and distribution in goods and services. B. Sales tax, a tax levied at the point of sale on the purchase of goods or services, often by local governments. C. Excise tax, a targeted tax applied to specific goods, such as alcohol, tobacco, and gasoline. This tax often aims to regulate consumption or raise funds for specific purposes. 3. Other types of taxes. There are also taxes applied under specific conditions or on particular transactions, including a. Inheritance tax, a tax on assets passed down from a deceased individual to their. B. Capital gains tax, charged on profits from the sale of assets, such as property, stocks, or bonds, when these assets increase in value. Understanding these types of taxes helps governments manage tax revenue and ensures that the tax burden is distributed fairly across society. 3. Tax rates. Tax rates vary widely based on the type of tax and the taxpayer's financial status. The primary structures for tax rates are as follows. A. Progressive tax rates. This structure taxes higher income levels at higher rates. Progressive taxation aims to distribute the tax burden more fairly by requiring those with greater financial capacity to contribute more, helping address income inequality.
B. Regressive tax rates. In a regressive tax system, lower-income individuals may end up paying a higher percentage of their income than those with higher incomes. Regressive taxes are often indirect taxes, such as sales taxes, where everyone pays the same rate regardless of income level, potentially putting a greater burden on lower-income taxpayers. C. Proportional, flat, tax rates. Under a proportional tax, the same tax rate applies to everyone, regardless of income. For example, all individuals or corporations pay a flat percentage of their income. Flat taxes are praised for their simplicity, though they may lack progressivity. Choosing the right tax rate structure allows governments to achieve their fiscal policy objectives, balancing revenue needs with the principles of fairness and simplicity. 4. Functions of taxation. Taxes fulfill multiple crucial functions that support governmental and societal objectives. Revenue generation. The primary function of taxes is to generate revenue that funds essential public services, including education, healthcare, infrastructure, and national defense. Without sufficient tax revenue, governments would struggle to provide these services, which are fundamental for societal well-being and economic development. B. Redistribution of wealth. Progressive tax systems help reduce income inequality by imposing higher tax rates on high-income individuals. The revenue from these taxes can then be used to support lower-income households through social programs, public health care, and education. This redistribution helps create a more equitable society. C. Economic regulation. Taxes can influence consumer and business behaviors, enabling governments to address specific economic and social issues. For example, excise taxes on alcohol and tobacco aim to reduce their consumption due to associated health risks. Similarly, carbon taxes or green incentives promote environmental responsibility and encourage sustainable practices. D. Economic stabilization. Governments use taxes as tools to stabilize the economy. During periods of high inflation, they may increase taxes to reduce demand, while in times of economic downturn, they may reduce taxes to stimulate spending and investment. This helps maintain economic stability and mitigate the impacts of economic cycles. E. Social functions. Taxes support welfare programs, social security, and unemployment benefits, providing a safety net for citizens. By funding these programs, taxes promote social welfare and contribute to a stable, resilient society.